to individual investors, recommend stay long. No reason to get out yet. The market just made a new high a couple of days ago. You might hear people at Adam Taggart's show telling you to get out. There's going to be a crash ahead. But what we're telling our clients is there'll be a crash. The market's going to go down 50%. It first has to go down 7% or 8% before it gets down 50%. And
Sure.
clients following this program can sit through a 7 or 8% decline as long as they know there's a model that's going to get them out before it's down 50%. And that's exactly what they're trying to do.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today we've got the good fortune to speak with Milton Berg, founder and chief executive officer of MB Advisors, a premier global macro research and consulting company offering investment advice to the world's largest asset managers. Now, Milton's just made his proprietary buy-sell model available to retail investors for the first time, and he'll walk us through it today. Milton, thanks so much for joining us. Hey, it's a pleasure to see you, Milton. I think we've had you on once before, at least on the Thoughtful Money channel, but great to have you back on, especially early in 2026. Happy New Year. I hope you had a wonderful holiday with your family. We're off to an interesting start already here in 2026. So why don't we just get to the meat of it right out of the gate here? We'll go through your whatever charts you want to go through in a second, but at a high level, if you had to kind of pick a word or a theme to define what you expect 2026 to be like in the financial markets, what would it be?
Unusual.
Okay, unusual.
Unusual market, right? Not a regular market.
All right, and what are the main reasons why you picked that word?
Well, basically, you're seeing a culmination of years of speculation. Say gold and silver, platinum, palladium, goes up some 185% over the last few years. And the public is seemingly, and institutions as well, are saying, "Hey, there's inflation. Let's get on the bandwagon, get on gold now." But Weinberg shows me they were at the end of a long-term move rather than the beginning of a move. So with gold and silver probably going to reverse, with Bitcoin already in a bear market, with the stock market, according to some measures, as overvalued as it's ever been in history. Although we don't use overvaluation in our work, but the reality is an overvalued market is more likely to have some either hiccups or bear markets than a market that's fairly valued or undervalued. So markets worldwide and the debt situation. So I'd say it'd be unusual. I'm not saying the market is going to go down necessarily. When markets are in the current situation, usually you see more volatility than usual. You see more corrections than usual. And sometimes you see major bear markets in that situation. Not what we're projecting, but I just say it'll be unusual and different.
Okay, so we had some great years in the markets for investors during COVID, right? Because just so much liquidity was getting shoved into the system. Folks then got surprised in 2022, but then we went right back to pretty quiescent markets that just like to go up. Sounds like you're saying 2026 is probably not likely to be nearly as quiescent. It might not be 2022 bad, but it's probably not going to be just the easy ride that we've had the past couple of years.
Well, it really depends on what takes place during the year. I mean, inflation is still high. There is chances of recession, so it's really difficult to predict at this time exactly what will happen. That's why I use the term unusual. I'd rather not make a projection, but once we're getting to the data, my data is saying, giving us many clear indication as to both what stocks and bonds could do, as well as what gold could do. So once we get to the data, it won't be just an opinion.
All right, well, far be it from me to stand between the viewers of this channel and the data. So why don't we get to your slides, Milton, and I'll just let you drive. You take us anywhere you
Okay.
like.
Well, first I want to start with we have two types of clients. We have institutional clients who are is somewhat more trading oriented. They're able to use leverage. They're able to go to sectors. They're able to go short one sector, long another sector. And now we just started a new project where we have retail, we call it individual investors. And individuals are more interested in the long term. So let me start with the institutional side a little bit. For the institutions, we're actually recommended to go short on December 11th, actually December 12th, December 11th at the close. On December 11th, we got a very rare sell short signal based on the VXN. VXN is the VIX, but it's a VIX using the NASDAQ 100 rather than the S&P 500. So we get I don't give away the secret sauce here, but basically we look at a short-term ratio to a longer-term short-term ratio to see some sort of a major shift in VXN relative to its short-term trading pattern. And this gave us sell December 11th. Now, through yesterday's close, the S&P has only gained 0.91%, 21 days past that signal. So everyone's so excited about the great 5-day, 6-day return we had earlier in the year. The reality was this short sale on December 11th is still very, very valid. Even though the market's up 0.91%, for example, in 2021, when we got the signal, on day 21, the market was up 0.94%, and the total decline from the date of the sell signal was 21.41%. So being up 0.91% is meaningless. We're short for our institutional clients, and if we're stopped out, we'll be stopped out. If we get 2.75% above the close of December 11th, this trade will not have worked. But at this time, despite all the hype and everyone talking about the first 5 days, telling you what's going to happen for the rest of the year, the models we look at tell us to be cautious, at least for institutional type investors who can trade, who are watching the screens every day and able to get in and out. So our official recommendation now is to be short the S&P 500 or whatever index you choose. That's as far as that goes. Now, I say we'll talk about the retail investors. For the retail investors, or we call them not really retail, but we call them individual investors, it's a totally different story. So what we have is this. We went long. We have a model we created. I spent 10 years working on this model. It's a model unlike anyone else in Wall Street has, which I hope to demonstrate in the next couple of minutes. But basically, this model we begin this model in 1957 for the S&P 500. The first question we're asked is, the S&P 500 began in 1928. Well, what kind of model starts in 1957? Well, the answer is in 1958 to 1957, there were only 90 stocks in the S&P 500. And the committee that was deciding what goes into stocks was very, very slow. So stocks weren't changed that often. In 1957, they raised it to 500 stocks. So now it's a very broad index that represents 80% of the total U.S. stock market. So we started in 1957 to create our models. The model since 1957, getting in and out, basically, we have an average of one round trip trade in 1.25 years. Again, it's for individual investors. A hedge fund couldn't get away with this. But basically, since 1957, the average trade, you buy S&P and you sell the S&P until you buy the S&P again, it was an average of 1.25 years per trade. And we have the models telling us that the gain per annum was 18.5%. This is total return, including dividends, relative to a buy and hold gain per annum of 10.9%. So it's a very, very amazing outperformance. Now, many institutions, almost all institutions would be happy to have a 68-year track record of 18.5%. I don't think there was any institution that has that track record. Even Warren Buffett has sunk below it. So it's an amazing return. So on individual investors, we recommended getting long on April 4th. Again, that was just a theoretical recommendation because we didn't start our individual investor program yet, but we started an actual account on June 1st, and that account is up nearly 18% since June 1st, being 100% invested in the S&P 500 through the VOO rather than the SPY, because the VOO has a less expense ratio than the SPY does. And we actually slightly outperformed the market through yesterday by 0.3%, which is fine. So to individual investors, recommend stay long. No reason to get out yet. The market just made a new high a couple of days ago. You might hear people at Adam Taggart's show telling you to get out. There's going to be a crash ahead. But what we're telling our clients is if there'll be a crash, the market's going to go down 50%. It first has to go down 7% or 8% before it gets down 50%.
Sure.
And clients following this program can sit through a 7 or 8% decline as long as they know there's a model that's going to get them out before it's down 50%. And that's exactly what they're trying to do. So this is the first thing I want to discuss. And
okay. Milton, can I ask you one question about this model that you're trading off of now?
Yeah.
Is it binary? Is it 100% in the S&P or 100%
market,
stuff?
we believe as long as America remains a capitalistic society, and I can't predict the future, you never know what's going to happen 10, 15 years down the road. But as long as America remains a capitalistic society, the stock market should continue. What it's done over the years is go higher and higher and higher. On an index basis, it's up 7.9% per annum over the last, say, 100 years. On a total return basis, it's up nearly 11% per annum. So that should continue happening. So we tell our investors the S&P 500 is the broadest index. You're not an institution. You don't have to try to pick which sector. You don't have to pick either technology or pick biotech or pick utilities. Get it. 80% of the stocks of the value of the stock market is in the S&P 500, and that's where you're going to be to take advantage of the major up moves. The problem is people don't want to sit through down moves, and that's why we have the model The model tells you when to get in. The model is very, very precise, which we'll see soon, in when getting in. It's not very precise in getting out. So what we did is I wasn't able to model market tops as well as modeling market bottoms. So we said to ourselves, either the market's down 7 or 8%, no matter what the fundamentals are, we're going to get out and wait for the next buy signal. Just to point out, going back to the previous chart, you see we show us 18.5% if you got out at 8%. You actually have a greater return if you got out when the market's down 7%. The
Huh.
problem is there's far too many trades. We're having 1.25 trade per annum. If you get out at down 8%, you have about more than one trade per annum if you get out at 7%. So basically, we really favor getting out when the market's down 7%, but we retain that flexibility. I'm not telling our clients that I promise you when the market's down 8%, 7%, you'll be out, because most likely you won't be out unless the market's down 8% or so. But that's not etched in stone. What is etched in stone is when we get in. And we try to get in. The models are built to get in really within days of a market low, and it's been very, very successful in doing that. So these are this is just one chart showing all the buy signal dates since 1957. And you can see April 4th, 2025 was the last buy signal. Prior to that was November 2nd, 2023. And we'll get to the next, give you a little bit better idea what we're doing. This is what the model has done. I'll get to the insides of the model very soon. Now I just want to give you the background as to what the model has done for us and exactly what goes into the model, because I know everyone is going to be very skeptical when they see this data, because no one has ever created this type of a model in the stock market, especially not using leverage and just using a broad index.
Mhm.
So this is we call it the edge model, and Milton Berg edge is what Jennifer decided to call it.
Hmm.
And this is the yearly return relative to the S&P 500. So I highlighted the years in which the market went down just to give a contrast. So in 1962, with the S&P down 8.83%, the model was up 18.55%, basically because it was out during the bulk of the decline and got in within days of the low in 1962. In 1969, the market was down 8.4%, and the model was up 0.99%, again outperforming. 73, there's a 73-74 two-year bear market. In 73, the S&P was down 14.8%, and the model was flat, down 0.2%. But in 74, with the market down another 26%, the model was up 20%. This is what basically should take place. In
Right.
bull markets, they'll do exactly what the market's doing. Let me give you an example. So in
That's
19,
amazing, though. I just got to
2014,
say.
2014, the model's up 13.5%, so is the S&P. 2013, the market's up 32%, and so is the model. So in an up market, you're not going to outperform the market. But when the market goes up, has either correction or a bear market goes down, and you're out for even a small part of that decline, and you get back in close to the low, you'll do well. Now, we all know investment advisors are taught to tell the clients, if you miss 5 of the greatest days in the market in any given year, you're going to way out underperform. So don't bother timing the market. That is very, very true. If you miss the great up days in the year, you'll do very, very poorly. But you'll certainly do very, very well if you miss the down days, the bulk of the down days. And as we know, in any bear market, the greatest volatility doesn't take place early in the bear market. The greatest volatility takes place at the end of the bear market. So if you're out at a 7 or 8% decline and the market is going down 20%, you will be able to retain some of the great losses that index investors have. And if you're getting close to the lows, you probably gain nearly all of the gains you're going to get on those glorious rallies that take place off a major low. Anyway, this is something I wanted to show as well, which is just the year-over-year model and exactly what it has done for what it has done theoretically. Now, I
Well,
mentioned
you've
in the
sold
first,
me. Those are super impressive returns.
super impressive. I know, be skeptical. I want you to hard questions when we get under the hood. We're not under the hood yet. Just giving the background. Just
Yeah.
a sales pitch. Number of trades per year for the S&P 500, S&P T-bill. This is the model where you long the S&P 500, no leverage, and when you sell, you don't go short. You purchase T-bills or a money market fund. And I just highlighted the years there are no trades. See, 58, 61, 63, 67, 77, 72, 83, 81, 2024, 20, no trades. So this is perfect for a long-term investor who doesn't want to be calling his broker every day, doesn't be looking at CNBC to figure out when the next crash coming. He may not be so interested in listening to Adam Taggart any longer, because he'll know he has this kind of a program where you'll get out before bear market fully develops, and he'll get in at the lows. Now, I know this sounds very, very like I'm a charlatan or so, but we're going to now start getting into, in a couple of minutes, we'll get into under the hood and see exactly what's involved. As I say, I worked on this for 10 years. I think nobody else has a product even similar to this. And again, my institutional investors have seen a lot of this in the past, but even for them, I only finished the model in September of this year. So it's now sort of, it's totally complete, but they've seen a lot of my models. but now we've systematized it a little bit more. We have about 2,000 models. For the individual investor account, the models that we're showing were built using about 880 models, not all 2,000. And there's reasons for that. We'll get to that later on. This is the actual total return, showing the trade by trade total return. Control L. It'll make it a little bigger. Basically, the model has gained 18.5% since 1957. A $10,000 investment in an IRA or a tax-free endowment from 1957 to 2025 would have grown to $1,107,896. That's the
Oh my God.
miracle of compounding. The S&P, which has grown 10.9%, which is a great return, the 10,000 would have grown to 10,377,654. That's not a bad return either. But we're trying to do something that is not expected. We're trying to see returns double or triple, not return double or triple, but we want to see a balance after 30, 40, 50 years of investing in a retirement account. We want to see it 5, 6, 7, 8, 9, 10 times greater than it would have been had you strictly stuck to an index fund. When the model is long, while it's long, the average gain is 26%. The average gain when it's positive is 26%. The average loss when there's a loss in the trade is 1.41%. And we'll see, it sounds ridiculous. Let's continue. We actually know theoretically, if you have a model that goes flat when you sell, you should be able to make money if you go short. So we don't not recommending anyone to go short because it's far more volatility when you go short. But using the same data and using the same dates, had someone started in 1957 and had he bought SP 500 on a buy signal, and rather than invest in T-bills, had he went short the market, he would have gained, rather than 18.5% per annum, he would have gained 22% per annum. So his $10,000 would be worth $8,793,203,930. Okay, $8,793,203,930. There's a P
That is
on the other
crazy.
hand would be up at 11% is up to 13 million, 12, 13 million. So pointing out, I say this because theoretically, as you know, it doesn't make sense. No model that gets you out of stocks and is successful, any model that gets you out of stocks and is successful must also be successful if you go short instead of going to T-bills, or else there's something wrong with the model. That's just normal mathematic theory, and that's what I want to point out. What you would have done if you go short, but we're not recommending you go short based on this model. Now, let's go a little bit further and see this. This is the 5 years. I broke from 1957 to current to 2025 in 5-year increments, so your viewers can get an idea of exactly what the buys and sells look like. So the first buy takes place in early, it's actually in October of 1957. Here's a sell, an 8% market decline, and the market, we didn't get any buy signals until right here. You see, I'm going through the 5 years at a time. This is a 95.4% of the long trades are profitable, 18.5% per annum. So this is basically here you got a sell and a buy within days of each other. The market was down some 8, 9, 10%, and we got a buy immediately after the sell. There are 3 instances where you got a sell and a buy in the same day. We don't display that. For example, I'm going to show you which one it is so you'll know. Just for in 2011, right here, 2011, this decline here, you see? This was
Yep.
in 2000. The market was down 7.5% one day. By the close of the next day, it was down 12.5%. It was down 5% on one day, the day of the low. We get a buy signal on the day of the low. Actually, we show it here. It's a buy signal, but no, this is not 2011. Yeah, this is 2011. This is not the right date. 2000. I'm sorry. Then we did get a buy signal. That was a great trade. We're talking about in 2015, which is the next chart. I'm sorry. This is it. See, 2000 from here to here, the market was down from 12%, yet we didn't get a
Yep.
sell. Why didn't we get a sell? If we're going to sell every 8%, why did we not get a sell? The reason is because this decline of 12%, we got a buy signal right here. So then the count starts again, the market rallies, and you wait for the next 8%, which is right here. This is a very important thing I'm pointing out. We should have got a sell signal here on August 24th, 2015. The market went from down 7.5% to down 12%, but we didn't get a sell signal because we got a buy signal. And that's why the next sell signal doesn't take place until January of 2016. I want to get that behind us, and let's continue further. But basically, the point of this slide is just to show how this model works in real time, showing you the buys and the sells. And we can go to where we are now. The last buy signal was on April 4th, 2025, one day before the low. So most of the buy signals take place after the low because most of the models do not base itself on oversold based on a rally, often oversold. But when there's very, very major oversold conditions, we can get a rally, we get a buy signal before a low. Another instance of a buy signal before the low was in 2020. The market, we got the buy signal one day before the low. The market was down 7% the next day. But had you bought the day after that 7% decline, your return would have been lower than getting in the day before the low because the market was up more than 7% on that day. So this is basically a picture of how this works. It's just a mechanical. I could have made this up. How do we know it's even true, right? We never know. Plenty of charlatans in this business. Plenty of people who claim to have a model, but they really can't show what's under the hood. We're going to try to show next what's under the hood. First, I want to say the logic. How we've been published in the Journal of Technical Analysis, and this I think I may have had this chart in that report. It goes back about at least 10 or 15 years ago. We look for rarities. We don't look for crossing of moving averages, which happens, often. We don't look at necessarily what the Fed is doing. We look for rarities in the data. For example, this is a histogram of the VIX. It shows the number of days in a row. Okay, the VIX was up 2 days in a row, 11.9% at a time. It was down 2 days in a row, 13.5% at a time. If you look at 5 days decline and 4 days up, I mean, it's more than 60, 70%. We're looking for instances where the VIX is down 9 days in a row, or up 9 days in a row, 0.02%, 0.07%. So point number one is our models are not going to, no one of our models are going to call every top or call every bottom. We've created numerous models that have been built to call 3, 4, 5, 6, 7 bottoms. There've been 55 bottoms since 1957. But we're looking for rarities. We're not looking for generalizations. We're looking for things that only take place at market. Generally, for the model, we're looking for the things that generally only take place at market lows. Let me give you another histogram because this is an actual. The VIX days in a row. It doesn't go into our model. I just show it for illustration purposes. But this is one of our models. We coded it MIL 35 MA BN 35, which is basically on a 5-day basis. You're looking at net up volume versus total New York Stock Exchange volume. Okay. And in any index, whether it's New York Stock Exchange or the S&P, some stocks are up and some stocks are down. The stocks that are up have volume, and the stocks that are down have volume. We're looking for extreme volume in the stocks that are declining relative to the stocks that are advancing relative to total volume. So we're looking for periods where the numbers are 55, 60, minus 55%, minus 60, minus 65, or on a thrust off a low. We're looking for these kind of numbers. These numbers in the middle are meaningless to us. So while we can't give an opinion on the market every day. Our opinion, which we started out saying, is individual investors should remain long, not because something is happening today. Should remain long because we got a major buy signal on April 4th, and there's no reason to sell. The market hasn't even corrected 5, 6, or 7%. So most pundits out there are trying to say, oh, something happened today, it's affecting the market. No, what affects the market is what happens at major lows and what happens at major peaks. We had a major low, you had record oversold on April 4th. You had everyone worried about the Trump tariffs, everyone thinking we could head for recession or depression. I mean, great economists were dissing this market, dissing the economy. But we got buy signals. So the reason we're bullish now it has nothing to do with what's happening now. Nothing to do with it at all. We're bullish now because the market gave bullish signals on April 4th and we actually had 80 signals in April alone. We have over 100 signals in April and May, which the institutions get to see, the individual investors don't get to see. But that is why we're still bullish now. Now, why am I started the first slide showing the VXN sell signal. That sell signal may just give us a correction of 10 or 11 or 12%, and it may not even work. I don't know if that signal is going to work, but institutions, we're trying to get better than we do with this model for individual investors. So this is the histogram. Now we're going to try getting into the meat and potatoes, if you're ready for that, unless you have any questions, Adam.
Serve up the steak, buddy.
There you go. This is it. This is it. We said there were 55 buy signals since 1957. I prepared this to show all 55. We're not going to have time to show all 55, but we'll do the best we can. We'll start with the first one, which is right here. October 21st, 57, we got a buy signal. The market gained 85% before the next 15% correction. It gained 55% before the next 7% correction, okay? Great. Now, why did we get this buy signal? What happened? This is the model. Now, I want to point out, Adam, I don't go around telling everybody what's in my model, but here I have an incentive because we're trying to get clients. And we just went public with this retail letter a few days ago. We have over 1,000 clients, so we want to get up to maybe 100,000 clients through this these kind of presentations. So we're going to show a little bit of what we have. We were showing maybe 55 models. As I say, we have 2,000 models. But what happened October 21st, 1957? Well, first of all, the 5-day average of the New York Stock Exchange was the highest in 375 days, sometime in the past 20 days. That means that we're in a regime of high volume, number one. Okay? A regime of high volume makes sense to you? Markets
Yep.
don't always generate highest volume in a year and a half. So we're in a regime of high volume. The S&P 500 made a 60-day new low. The S&P has declined 12% into the low, into today's low. Up volume as a percent of New York Stock Exchange total volume, which I just showed you in the histogram, was at 45%, was at minus 45%. And we have what we call the reverse breath thrust. 5-day advanced declines in the S&P 500 was between 0.35 and 0.39. We call that a reverse breath thrust. Now, it happened right here in 1957. Let's look at the history. It happened, this is the signal. The green means it's part of our model. In other words, it's signaled on this date, and this what we're showing you now is part of that model. It's signal again at 6/26/1962. Again, the model goes long for the same reason, same signal. You notice in this case, the market gained 14% before the next 10% correction, but 79% before the next 12% correction. So this is a great long-term buy signal. Then September 20th, 2001. This is not, we actually got long on September 19th with a different signal. But in this case, the market was up 19% over 73 days in a bear market rally. So not every signal we get is going to lead to a major bull market. But in this case, it led to a 19% gain in 73 days. It happened to have been a rally in a bear market, but it's a very strong rally which we can capitalize on.
Mm-hmm.
Then it signaled on December 24th, 2018, which was I think it was one day after the low. No, it's actually the day of the low. And in this case, the market gained 44% before the next 12% correction. So, and then it signaled on April 8th, 2025. The reason we didn't highlight it in green, because this doesn't go in our model for that date, because we got a buy signal on April 4th through a different model. Now, I'm trying to show this one model in 1957 has given us a signal in 1962 and a signal in 57, but the subsequent signals we didn't act upon because we were already long the market prior to the signal based on other models.
Got it.
Got it. So this is the first model. Let's go to the next date, November 1st, 1960. Okay, the market had declined 13.85% into its low. And let's see what happened over there. Over here, you had the S&P was down 10%, and it bottomed 5 days ago, never made a lower low. Point number one, we do a day count. S&P corrects down 10%, and it hasn't gone lower for 5 days. Is that a bottom, or is that just it will decline? Let's see the next thing. The S&P was up at least 1% on the day. The S&P 5-day rate of change. In other words, in those 5 days off the low, the S&P had its greatest return in 90 days. The New York Stock Exchange was up on the day on increasing volume. Volume was up on the day. And the S&P was down into the low 5 days ago, 7 out of 7 days. Remember we showed the count of days? This has occurred a number of times in the past. It occurred in 11/1/1960, which is a buy signal. July 3rd, 1962. We don't list it as a model signal because we got long earlier than that date. And October 10th, 74, we got long on October 4th, 74. But the point is, like, for example, October 10th, 74, it was early in the bull market. The market never made it lower low. And the market gained 54% before its next 15% pullback. And we're going to get to modern times pretty soon, but this is another very important one. June 26, 62. I think that has something to do with the heart attack for Eisenhower. I don't recall exactly what the background fundamentals were, but I think it had something to do with the heart attack for, maybe I'm wrong about it, but I remember something like that. But then it wasn't the Cuban Missile Crisis. No, anyway, it doesn't matter what it was. We don't care about the fundamentals. What we care was the market was down 27.97% into this day. And we got a buy signal. Why did we get a buy signal? Well, again, the 5-day average volume was we were in a regime of high volume because within the last 20 days, we saw the highest 5-day volume in a year and a half. The S&P made a new 60-day low. The S&P 500, well, doesn't this sound familiar? This is the signal we had in 1957. So the signal we had in 1957 that got us long also got us long in 1962. And no reason of reviewing it. There's 57, 62, 2001, 2018, just as before, and April 8, 2025. Let's get to, you want to pick a nice bear market that you remember? We might as well do it that way rather than go through every one.
Sure.
Pick one.
Gosh. How about just the GFC?
Let's go to 2008 market. Let's see what we got. We had a buy signal on August 8th, 2024. excuse me, we had a buy signal on August 17th, 2007. This is the beginning of that bear market. The Russell 2000 peaked in August. The Russell 2000 made a low, down 10%, never made a higher high, although the S&P and the NDX and the Nasdaq made new highs into October. The S&P peaked on October 9th, and the Nasdaq peaked on October 30th. We got a buy signal. Of course, we got a sell signal prior to this buy signal. The market down more than 8%. We got a buy signal on August 17th, 2007. The market was down 9.43%. We got a buy signal. Let's see what happens next. So the market gained some 8.24% to the next top. So it probably was a wash because we held on. We got out when it was down 8%. It was a wash. Let's continue. When did you get a similar signal to the one on August 17, 2007? You got a similar signal on August 9, 2011. The market gained 81% before the next 10% correction. Got a similar signal on August 8, 2024. The market gained 15%. And as you can see, the median gain is 21% over the next year. Then on March 11, 2008, we got another signal within the bear market. The S&P had already been down 18.64%. This is when you had the Bear Stearns crisis. We got a buy signal. And in this instance, again, the market was up 8% in 48 days. It was a wash. We got in and we got out as the market pulled back. This signal, when did this signal on March 11, 2008, when did it take place in the past? It took place many times. It took place right here, 2008. It took place March 10th, 2009, which was the bottom of the bear market in 2009, which is the great financial crisis. It occurred in February 12, 2016. The market gained 54% before the next 7% correction. December 26, 2018, March 24th, 2020, all great times to buy stocks. Now, I didn't review what went into the signal. Let's do that. Very simple signal. Unbelievable, simple signal to give you all these great buy signals. Remember, the bull market bottom, bear market bottom, bear market bottom, bear market. Very simple. I mean, giving away some of the secret sauce here. The S&P 600 small cap stocks generated a four-day high, highest high in 4 days, 1 day after a 2-year low. Very simple. Anyone can understand it. We have 5 instances in history where the small caps were down at a 2-year low, and the following day they were up to a 4-day high. That's all we need for this model. And here we go. Buy signal here. We were flat on this one. Up 69% before the next 10% correction. Up 54% before the next 10% correction. Up 37% before the next 10% correction. And up 95.99% before the next 10% correction. Now, the question you're going to ask is only 5 instances. That's why I started telling you we're looking for rarities. It is very rare for a market ever to make a 4-day high, even after a 4-day low. Very, very rare for a market to make a 4-day new high 1 day after a 2-year low. When that happens, it means there's a sudden reversal of fortune, called a momentum surge, and that has given us 4 or 5 great buy signals, and occurring basically at the end of the bear market. So this is March 10th, 2009. The market was down 56% to the low, and we got the buy signal on March 10th, which is a couple of days after the low, actually 1 day after the low. And then you see it. Then we saw this on August 17th, 2082. On August 17th, 2000. Excuse me. I'm back to this. I'm sorry. We just went through the buy signal we had on March 11, 2008, and we got out. And then we said the next signal of the great financial crisis took place on March 10th, 2009. What went into that signal on March 10th? What the signal was very simple. The New York Stock Exchange had 15 times as much upside volume as downside volume. Let me explain what that means. In any index, some stocks are up and some stocks are down. The stocks that are up have volume, and the stocks that are down have volume. If the ratio of the volume on stocks that are up on the day is equal to the volume of stocks that are down on the day, the ratio will be 1 to 1. 15 to 1 means there's 15 times as much volume in the stocks that are up as in the stocks that were down. So number one, you had 15 to 1 upside to downside volume. Number two, the New York Stock Exchange was up on the day and had greater volume than the previous day. And number three is the S&P 500 itself had 70 times more volume in its up stocks than in its down stocks. This occurred on March 10th, 2009, a couple of days after the great financial crisis low. And it also took place on August 17th, 1982, right before 58% gain before the next 10% correction. It took place on August 20th, 82. March 10th, 2009, which just highlighted. Took place again on November 28th, 2011. So the same model that worked for 2009 is working for 2011. It signaled again on December 20th, 2011, and December 31st, 2012, with some short-term panic sell. We don't know why. And December 26th, 2018, and here's the advertisement. And our website is www.miltonbergedge.com if anyone's interested in anything more. It also signaled October 4th, 2022. That was a very interesting low because the Russell 2000 actually peaked in June while the Fed was still tightening. And the Russell 2000 exactly bottomed in June, never made a lower low in October. The S&P and the Nasdaq did make low lows in October, slightly below the lows in June. We got this model signals on October 4th, but we didn't highlight it in green because we were ready to long. We got long on September 26th, the day the Russell made its secondary low. We had a buy signal on September 26th. That's what we don't highlight as part of a model. April 9th, 2025, we have many clients, institutional clients, who are very, very nervous because the S&P was up 9% in the day. They say, oh boy, this is like a bear market rally, because some people believe that the only times the market rally 9% of the day is in the bear market, which is totally untrue. You can see a 9% gain in the bear market or in a bull market. And in this case, the upside downside volume is what told us to go long. So this particular model, just to go how we look at these models, we look at what is the greatest gain over the next 252 days after this model signals, because this model had many signals. So as you can see, 56%, 51, 59, 22, 18, 29, a median of 30.45% for this particular model. Then, anyway, that was a great financial crisis. I hope I gave you some idea what we're looking at.
Wow. Now, look, so it's clear the immense amount of rigor that's gone into this, Milton, and I love the fact that you can look at a pattern that appears, right? Okay, it's a buy signal, but you can then say, well, this is the same sort of buy signal we saw back here and here and here where it worked before. So a couple quick, just sort of practical questions for you on this. So if somebody is trading based off of this,
Yes.
should they just be buying the SPY, buying and selling the SPY?
This is we are recommending getting individual investors. Institutions are totally different. We have many institutional clients that are a totally different picture, but no sector choices. Just get into the SP 500. You have 80% of the stocks in the New York Stock Exchange. Historically, the SP 500 moves up in bull markets. If a capitalist system continues, should continue having bull markets. If we somehow turn it to a socialist system, you'll still have markets. But they're probably more volatile. So this model should still work. So yes, these clients, the retail clients, should not try to outsmart the model. The model is built buying the SP 500. That's all you have to do.
Okay. And again, I sort of asked this earlier, but I just want to ask it again for clarity's sake. It is binary, meaning you are
Binary.
all in or you are all out. It's
Not
not
incremental.
like,
And I'm glad you asked that again, because unlike our institutional service, this model acts on the first signal. In other words, we had two signals on April 4th. We had signals on April 8th. On April 9th, maybe had 30 signals. For institutions, I may decide, let's wait a little bit. Let's see how the market acts after you only had two signals. For the retail, the model is built. We're not going to use any judgment. We buy any signal, any first signal we buy. In this case, it was April 4th. And actually, it turned out to be much better than buying after April 9th, because it just turned out much better as far as returns go. So yes, it's binary, and we follow the first signal, and you're 100% long the SP 500 when you're long, and you're 100% long treasury bills when you're out of the market. And this is far, in my opinion, it's certainly less riskier than the 60/40 program, where people are on the market all the time. You get a bond bear market, what do you do? Which we saw. You get a stock bear market, like, what do? You just say, hey, it's 60/40. You have a bond bear market, a stock bear market for the same year, you're really in trouble. This is basically saying you're diversified, which makes a lot of sense. Be diversified, because the S&P 500 is diversification. You're going to take advantage of the great bull markets. There are many great bull markets, and we'll get you out of there before a major bear market. And if we got you out early and there was no bear market, our models will get you back in. And if we don't get you back in, the worst that happens to you is you're gaining 3, 4, 5% of your treasury bills until we get the next buy signal. So it's really, really a very simple, easy program. And the main thing for individual investors is they don't have to worry about what the market's doing on a day-to-day basis. We'll notify them when it gets time to get out, and we'll notify them when it's time to get in. Right now, they officially got in April 4th, and they're sitting pretty. If the market's up some 36, 37% since April 4th, you don't have to worry, because if you're worried the market's going to go down 30 or 40%, like some people say, it's the first got to go down 8%. So let's wait till it goes down, or 7%. Let's wait till it's down 7 or 8%, and then we'll reassess, and then we can get out. And instead of gaining 39% off the lows, you gain 30% off the lows. Still a great trade.
What this reminds me of, Milton, is Warren Buffett talks about Ted Williams as the science of hitting, right? Where Ted Williams kind of knew in his entire batter's box which areas he had the best chances of hitting the ball. And Ted Williams would say, basically, my job is to wait until the pitcher pitches a ball right where I want it to be. Now, what Warren Buffett says is the problem with Ted is that um, he could have strikes, so he might have to swing at a ball that's not perfect. Where Warren Buffett said, "I don't have that pressure. I can let 10,000 balls go past me until I see the right one." Your
Mhm.
model basically says, "Hey, we're looking at all the extremes, the real outliers that give us really high confidence that if we swing, it's going to be a good swing." And those don't happen all that often, as you said here. So like you're just waiting for the fattest, most obvious, highest probability win pitch, and you're only swinging when it's in that perfect
Yes,
sweet spot of your batter's box.
exactly. That's just half the story. Remember, waiting for that swing and waiting for that pitch. And once you get that pitch, in other words, imagine if Ted Williams is swinging, he got the right pitch, and for the next 15 seconds before the ball goes to the stands, he's worried. What if it collapses? What if a hurricane? No, once he got off the bat, you already know that it's going to go over the fence. You see?
Hmm.
Scientifically, this is exactly how this works. Once you get this combination of indicators at a market low, you know the market's going to rally. You don't have to worry about whether it'll rally. You don't have to worry when it starts turning down or when to get out. You don't, and that's really the thing behind it. Wait for the fat pitch, but once you get that pitch, you don't have to worry that maybe the market will decline. If it declines, you get out. But based on probability, the market should go up, as I showed you in various. Now, I want to point something out because I don't want to give a false impression because we have a large institutional client base. We're charging our individual investors $10 a month because I like to get up to 100,000 clients. So making really basically giving away all this research. But I want to point out something very, very important, and that is that institutional investors get far more than the individual investor is going to get. And let me show you what I mean. If we have another couple of minutes, I'm going to show you
Yep.
what we have for the institutions. Because I'm sure there's some institutional investors watching this and say, "Oh, I'm going to sign this for $10 a month." Yes, but you're not going to get what we give our institutions. First of all, institutions we give sectors. We have a long only portfolio, which I will show you in a minute. But let me show you exactly what I want to point out. Each of these dates represents a date that our model signaled. And I want to show you something. So this model was built on 50 indicators, 50 models, not even 50, 45 models. I said we have nearly 2,000 models. Let's just pick it. Let me just show you what happened lately in April, just to give you an idea, okay? See all day, see these hundreds of dates to 1957, all legitimate buy signal dates. I'm going to show you what happened in April. See the April 4th? We clicked on April 4th and we got this chart. Is a signal, okay?
Hmm.
I'm going to click on April 7th and we have just, yeah, we have two signals on April 7th. I'll click them both. You see, two signals on April 7th. It's unfortunate I can't screen the screen. Oh, I could, yeah, it doesn't work. You screen on April 9th, just to let you know, I'm going to open up all the signals for April 9th. You can see them as they open up. These are all signals. We have about 30 signals
Okay.
on April 9th, you see?
Yep. I see them popping in. Yep.
See that? The model was built using only one signal for each market bottom. For institutions, we have signals at the bottom, we have confirming signals, all taking place within roughly 10 days of a low, before a low or after a low. We have signals and more signals and confirming signals. And that's, basically we're holding hands for the institutions. But for the retail client, all they're going to get is that one buy signal. You hold on, hold the S&P till you get a sell signal. I mean, this is very robust data. We did a very, very serious work for this. But as I say, we share most of our research with the institutions. We decided this year to start sharing with the retail accounts or the individual investor accounts, and that's why we created these models. But I'm just opening more and more just the signal April 4th. Each signal is different than the prior one, you see, just to show what we have. If I could spread sheet a little differently, it'd be a little better, you see. You go to a place like the most signals we ever got on any days was at the low in 1982. Starting on August 10th, 11th, 12th, 17th, 18th, 1982. That's when the great bull market began. And then we have probably, I'd say over 200, 250 signals during that period. So basically, I hope I've done a good job and tried to explain what we've been doing.
All right, Milton. Well, look, let me get to the most important question then. So, for people who are, the light bulb's gone off, they've said, okay, Milton's built this amazing model. Institutions have benefited from this in the past, but now he's got a retail version of this. And honestly, it is an incredibly easy one for me to follow because I basically just sign up for $10 a month. And I kind of just go about my life. And then every couple quarters, every year or so.
We write a report twice a month.
Okay,
Just
you write a report
clients-
twice a month.
Right. And if we get a buy signal or sell signal within the week, we immediately will notify the clients, along with our institutional clients, but we'll be getting the data anyway.
Yeah. So as a client, I'll get, but the key thing is I can read your monthly reports as they come out. But from a trading perspective, I just go about my life until I get an alert that says, hey, we just triggered a buy signal or a sell signal.
Okay.
And that doesn't happen very often, as your chart showed, right? Maybe 2-3 times a year, maybe none at all in a year.
No, on average, one trade over a year and a quarter on average.
One trade over a year and a quarter. Okay, so it's again very easy. You can go live your life and then just trade when the model says to. So $10 a month. I think you put the URL up earlier, but I just want to make sure folks know clearly where to go if they're interested. What URL should they go to?
It should be www.miltonbergedge.com, I believe is what it is. miltonbergedge.com.
And Milton, when I edit this, I'll put the URL up on the screen so folks know where to go. Folks, the URL will be in the description below this video as well, so you can get there with one click. Milton, obviously, a lifetime of work has gone into this model. Congratulations on putting it together and making it available to the average investor here. Thank you so much for coming on and walking us through it. I know it's new in the sense that, yes, you backdated it back to the late 50s, but the model itself has only been live for less than a year. But really looking forward to seeing how the future performance goes, and hopefully it should go just as the backdated performance has gone.
It should go, yeah. Exactly. Thank you so
All
much.
right. All right, Milton. Cannot thank you enough, my friend. Look forward to having you back on later on in the year. Folks, please let Milton know how much you appreciate him walking us through all this by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Thanks so much for coming on, Milton. Again, best of luck with this new model and look forward to talking to you later in the year.
Thank you. Bye-bye.
All right. Everybody else, thanks so much for watching.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to do to gold. It's going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fed coin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at this, all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you're going to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? You might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with FedCoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single FedCoin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the FedCoin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? Is there some eerie similarities, like a sort of like a modern day computerized FDR scenario? Okay. Yeah. And so I think when people start seeing this, they start seeing, wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, first step is you just need to see things you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for FedCoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. Society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with FedCoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the FedCoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax.
Yeah.
And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid, when we learned about algebra, I was like, what's the point of algebra? And, my father is really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for Fed coin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the US is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So like that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually I'd do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that because there's no stopping where it's going. And the world definitely keeps going. And you can survive and thrive through change. People 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. You got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. Yeah. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double. And like, you can't even find all the stuff. I mean, it's like, I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash because, I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting and it goes up, and I just think that to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I think we've got another 5 to 10 years. in gold?
Best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Gold and silver remain in a long-term bull market, driven by central bank buying, ETF accumulation, and rising debt that prompts investors to seek inflation hedges. While gold still has another 5 to 10 years left in its bull market, analysts like Mario Inaco and Clive Thompson believe prices will continue to climb until a major crisis, whether driven by monetary, geopolitical, or systemic forces, forces a reset into a new currency system. Until then, market sentiment suggests continued gains and a potential final explosive rally within the next decade. The speaker, Mario Inaco, a financial market expert, mentions that Bert Doman, founder of Doman Capital, conducted a long-term cycle study of gold reaching back centuries. He identified a 20-year bear market that started in 1980, which ended around 2000, followed by a secular 30-year bull market that began in 2001. Based on this, he believes the current gold bull could continue through 2030 to 2031. The narrative of a prolonged upward trend amid systemic financial pressures finds strong consensus among many observers. Based on this, it is concluded that gold still has another 5 to 10 years remaining in its bull market. Clive Thompson notes that the bull market in precious metals is likely to continue until a new dollar, pound, or gold-backed currency, or a central bank digital currency, replaces the current currency system. Until then, rising government debt and recurring monetary, bond, or geopolitical crises will continue to drive investors toward inflation hedges. The excerpts from the interview are now available. Please click the bell symbol to receive timely updates, and subscribe to our channel before we continue our conversation. Thank you, and have fun watching the video.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market. Why do I say that? Well, I listened to Bert Doman. He's a fund manager, and I think he started out in the 70s. He's originally from Germany, but he's US based. And he said that in the 70s, he got his clients into gold in the mid-late 70s, and they did very well. And then in 1980, he told them, you need to get out of gold. We're going to have a 20-year bear market. And everyone thought he was crazy, but he was right. And then he said, but after that, there will be a 32-year bull market. And I think he looked at the price of gold going back a few hundred years in the UK, because the UK and the US are linked, the prices. So if you add 32 to 2000, you get 2032, and that's why I'm looking for another 5 years at least. But I think Jim Sinclair used to say that the next move higher in gold, let's say, it's not going to be like in 1980, because we went up to like almost 900, and then the next 20 years we drifted between 250 and 400. He thinks it's going to stay up there next time. It's going to be different. So I'll let Clive answer that.
Well, I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along and they'll be pushed into a situation where people are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Rafi, in the interview with Clive and Mario, recalls that the gold to CRB ratio indicates gold's value relative to other commodities. Since 2000, it has been in a clear bull trend, despite occasional pullbacks. The 2020 oil crash, when prices briefly went negative, sent the ratio into an extreme spike. However, since gold and silver bottomed in 2022, the ratio has been climbing again. Currently, the chart suggests we're halfway through this significant upswing. Unlike during the lockdowns, oil and other commodities are not depressed. Yet, gold is still rising strongly, indicating solid momentum in its ongoing bull market. However, Mario, along with Clive Thompson, notes that with the global adoption of Basel III capital rules now underway in the U.S., allocated physical gold is formally recognized as a Tier 1 asset, on par with cash and treasuries. This institutional shift underpins the demand for gold, reinforcing its status as a financial backstop amid potential changes to the monetary regime. Governments are rapidly developing central bank digital currencies. The EU is fast-tracking its digital euro proposal to counter the growing dominance of US-linked stablecoins, while China is expanding international use of its e-Chinese yuan and considering yuan-backed stablecoins for cross-border trade. The UK is also developing a digital pound, with consumer usage expected in the late 2020s. Now, let's have an insight into the interview.
So this is the gold to CRB ratio. All right, so it goes back all the way to 2000, but I picked 2010 here just so you could see.
Yeah.
This is if we're in a gold bull market, then this is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to -35, so that's why it went so high here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Well, we do take long-term mortgages, but the rates are set short-term, like 2 and 5 years. So they are based on the like 2-year swap rate, they call it, and the 5-year. But I think long-term rates, they've been going up a lot. They're making like highs, 27-year highs, like the 10-year, the 30-year yield. And what that will do is that's going to hurt the government. That's going to increase the deficit. That's going to inflate things even more. And I think the Bank of England is going to have a tough time cutting the short-term rate. So even though in the UK we don't use the 10 and 30-year rates to set mortgages, I think things are going to remain tough. Clive?
Well, banks, when they lend money for a mortgage, whether it's in the UK or any other country, they are effectively lending that money out for the next 20 or 30 years because they're not realistically expecting anyone to repay the mortgage in the next 6 months. So, of course, long-term rates have to have an effect on the interest rate they're going to charge you on the mortgage. Yes, there's an influence in the UK because they set the rate in some way to the 2 or 6 or 5 year term, and then it gets rolled over at a higher rate regularly. But at the end of the day, if long rates are pushing higher, the banks have got to have their heads screwed on and say, well, we've got to charge our customers a little bit more, because at the end of the day, the alternative, we don't have to lend the customers the money on their mortgage. We could go and put the money into a 30-year bond, which is effectively the same thing, instead of lending it to my customer. So if the 30-year bond rates were to go to, say, 7%, you won't be able to, I don't think you'll be able to get a mortgage for less than 7, for sure.
Rafi, you got an opinion on that?
Yeah, so what Clive is saying makes logical sense. If a bank can lend the money to the government with much less risk than it can lend to somebody for a mortgage, with a much lower default risk to the government, obviously, then whether 30-year mortgage rates officially set mortgages or unofficially doesn't make that much of a difference. It makes a little bit of a difference, maybe in short-term fluctuations and stuff, but there shouldn't be too much of a spread between 30. I mean, there shouldn't be more 30-year mortgage rates shouldn't be substantially lower than 30-year bond rates. It shouldn't be lower at all. But if it is lower, it shouldn't be that. It definitely shouldn't be that much lower. So yeah, their mortgages are set by long-term rates, either formally or informally.
Gold and silver remain firmly in a long-term bull market supported by systemic pressures, central bank accumulation, and the institutional recognition of gold as a Tier 1 asset. With CBDCs on the horizon and financial uncertainty growing, precious metals are positioned not only as hedges but as anchors in a shifting monetary system. Meanwhile, miners' renewed strength suggests the bull market is still in its early phase, with significant upside potential if gold prices hold above current levels. Do you think the rise of CBDCs will accelerate demand for physical gold as a parallel store of value? Could gold miners finally see a sustained re-rating, or will they continue to be a niche play despite strong fundamentals? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpass 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder CEO of Monetary Metals, points out that a recent U.S. customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something's something, that's going to cause the price to go up. It always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. It would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper, but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing in the U.S. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100-ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. And you read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit, and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could, because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, are made in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold to this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long-term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croft. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Croth even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
There's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this, I sold my company in August of 2008. So I guess we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale, right? That was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, oh, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over, and then everybody, wants to buy. Yes, it's true in places like India, if gold is perceived to be too expensive, and it's also out of reach for, very large numbers of Indians just don't have. Minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011. Right, we shot up in late 2010, silver was under $20. And by, was it March? Did it hit peak or April in 2011? It was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It was like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? You could. Will we see 30 on the gold-silver ratio again? No way. To see 30 on the gold-silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainty surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.